Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to do our go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's just dive right in. Let's take a look and see what people are sharing, and I'll interject my opinions as we go. If you want to follow me, it's at @Finding_Finance, and if you want to join our community where we have a Discord channel and talk a lot about investments. Pretty good community that we're building here. Finding-value.com if you want to join it. I also share a lot of my personal opinions on companies, macro environments, sectors, just about everything. Most people ask whatever questions are on their mind, and we dive into all of that. Coming to HFI research, it says, is OPEC Plus trying to force a recession? Saudi crude exports, and they are down quite a bit here in June. What is going on there? And maybe there is something going on, and I can't tell you what that thing is yet. The news generally comes out after, but if we do have a lot of economic data that is pretty weak. And if we do get a launch in oil prices, that could cause a recession. Very well could. And it's almost like, is OPEC Plus trying to force a recession? They would do that by exporting less oil and basically forcing a big move up in oil prices, which could cause a potential recession. It's almost like the catalyst that pricks the It's the catalyst that sets everything in motion, is what I'll call it. Correlation Economics says, yes, I'm betting on oil to crash and gold to soar. And what I always try to do is I try to understand those people's opinions on why. And I think I know why. I think it deals with unemployment going up. I think it deals with the yield curve that's inverted. And obviously a lot of economic indicators that have slowed down. And we're going to talk a little bit about all of that with a bunch of different posts that have been posted on Twitter here from different people. And I'm just putting all this information, tying it together, wrapping it up for you guys, the listeners. So it says, is oil about to crash? And what they're doing is they're looking at the yield curve. It says every time the percent inversion of the yield curve has gone above 70%, crude oil has crashed at some point within the next 2.5 years. Although in 2008, we had a massive squeeze, the oil had a max monthly drawdown of minus 41%. If history repeats, oil could go to $45 or $40 a barrel. We had the crash of the NASDAQ bubble crashing, and it was down 41%. We had another crash, 41% lower here from this portion to that portion. We had a big 66% decline when this uninverted for COVID, but that is a pretty extreme situation with shutting down the entire economy almost. And then we've got this sitting there going sideways, and a lot of people are betting that this is going to uninvert and cause a potential crash like we've seen in history there of those three other times. The problem is the charts are not indicating that yet. So maybe it's out in the future just a little bit, maybe not. We are sitting on top of this consolidation and support, but that doesn't mean it can't dip down for a period of time, much like this recession here. In 2001, we could easily get that dip, and I've talked about that on the website, about that dip, potential slowdown. But this is really difficult to nail down here, and I'll go into why that it's difficult to nail down here. But the big picture view and a lot of the data that people look at are indicating that if this does uninvert, we get a 2-year yield to really fall off a cliff, potentially crude oil could have a downside blip for a little while. 1929 concentration, and this is further evidence of a potential slowdown because a lot of these things occur right before the slowdown and before a potential crash, and we very well could get a slowdown in technology stocks and the S&P 500. So this is top 10% of stocks by size versus the entire US stock market. And this is the market cap concentration among the top 10% largest US stocks. You can see there's a big concentration in 1929 before that crash, a big concentration in 99, 2000 before that crash. We have another instance today that matches 2000 and 1929. So what is the likelihood of a potential crash with the concentration that we see here, with the yield curve inverted the way it is, with a lot of economic indicators and potentially unemployment going up? What is going on here? Could we see that? Yes, we could. I think we could easily get a tech crash much like 2000, 2001. I don't think it's going to be driven by the real estate market, but the real estate market could easily play along with the rates where they're at today, and people could get scared. I'm not saying that the home prices would go down. What I'm stating is like home builders could sell off along with a market liquidity type event if one does occur. We've got total bank credit here, and I said notice the breakout in 1999 in the commodities bull market. This is total bank credit divided by GDP as a ratio. So think about bank credit going up faster than GDP. That occurred all the way back in 98 and peaked in 2008, which coincided with the CRB index going up. We had that go sideways for a while, and the commodity sector consolidated lower. We got a nice clear breakout in 2020, and we've got a retest here that just occurred. If this breaks to the upside where total bank credit outpaces GDP, I think we're going to see commodities go up. But you're going to say, well, Andy, you just said that there's the possibility of a slowdown with a yield curve that's inverted and unemployment that's been going up. And I'm like, yep, we've got data that doesn't match. We don't have confluence of all that data. Because you can look at certain things and you can glean certain pieces of information from it. We also have an oil to gold ratio at about 30, which is really cheap for oil. And people are calling for an oil crash. Now, it doesn't mean that it can't get cheaper. There very well could be an event that occurs or something that the governments do around the world to create the event. I don't know. But we do have data that's kind of crossing streams all over the place here. And this is that unemployment rate I wanted to talk about. So this is the unemployment rate in 2 and 10. So this is the 2-year, 10-year. We have the inversion here. But look at when it uninverts. So when it uninverts, the unemployment goes up. So unemployment goes up. An uninversion here, unemployment's going up. Uninversion here, unemployment's going up. And then we have an uninversion here and unemployment rocketed here. And here we are coming back, and we're kind of coming back higher here recently, like we're putting in a bottom. So if the yield curve starts to uninvert and unemployment goes up, that's not a good sign. Definitely not a good sign. And I'm watching all this stuff, and very well possible could happen. On the bottom here, I've got U.S. construction employment, all employees is what I've got here on the bottom. You can see when that dips in construction, unemployment goes up almost every time, but we're not getting that dip in U.S. construction, at least not yet. So you can see when it rolled over here, unemployment went up, rolled over here, unemployment went up. So there is a strong correlation between the economy, unemployment, and U.S. construction all employees, because that's where a lot of the unemployment comes from. It's also an indicator of spending and the economy's strength or weakness in U.S. construction all employee hiring. So we have seen some hiring go down in terms of job openings. But are we on the precipice of a potential slowdown? And that's kind of the difficult spot to make a call here. And some things I've been monitoring. This is DHI. So someone made a comment down here. It says DHI weekly home builders are heavy. And he put a trend line here. So I wanted to respond to that. So this is my opinion on the home builders there. So home builders, if you draw a technical line here, why did I draw the line there? Why is it significant there? Why didn't I draw it a different way? Why didn't I draw this all the way upwards to try to make a rising wedge? Well, the last bull market, it went from expansion phase, at least, from 99, 2000, all the way up to 2005 for home builders. It rolled over and we came on lower. We had a consolidation. That consolidation was hump 1, hump 2, and then hump 3, which ended here in 2020, in my opinion. We broke out of this consolidation period, did a retest on top of it. The retest held, and we are now making a new higher high and higher lows. This is in an uptrend. It's not peaking out. So the way he drew DHI, I don't know if I agree with it. And he's only looking at the very short term here, where this little circle is at the top. So to me, the bigger, longer term view, home builders still look good. And that's important because that's a gauge of the economy and a gauge of when we could potentially have a slowdown that is being driven by the real estate market. If something does come, I don't think it's driven by the real estate market. Here's another chart. I stripped it of its symbol because this is a part of the website and some of our investments. We also have broken out to the upside of this trend line here, and it's sitting on top of it, using it as support where we could launch from. That doesn't necessarily occur and does not look like a peak. When you look at some of these home builders, this looks like like basically coming off of a bottom where we could launch from it to the upside, like we did in 99 to 2005. That was the big move there, which, just an FYI, that is a 100 bagger. Another one, which is a home builder, I'm trying to gain more confluence of evidence. I'm looking for evidence in home builders for topping. This one is also broken above its resistance line to the upside and looks good to continue higher. And my guess is that interest rates will be the driver of it. Lowering of interest rates, lowering of mortgage rates, I think will send this higher over time. And the bull market, last bull market from 99, 2000, you can see in 2001 we had that recession. And then from 01, when they lowered the interest rates, this thing just went like a beast. I think something similar is coming to that. And maybe we're slightly early to it. And here's another one. This is Leonard Corp. I'll talk about this one. Consolidation in 1981 with lowering of interest rates. The lowering of interest rates did not increase home building. It's driven by supply and demand and the demographic. The guys that think that lowering of interest rates increases the price of homes is completely wrong. You can see the shoulder top in 2005, and then the subsequent big move lower. We had a big consolidation. We've broken that consolidation above 2008, did a retest on top of it, and we've been making a higher low and a higher high on top of that. That does not look bearish on a longer term time frame. That's what I'm trying to gauge, these longer term time frame and bigger moves. Brian says the most important financial decision you will ever make is to always live below your means. And I was thinking about that after I read that, and I was like, you know what? That's probably true. It's probably true. And then we'll skip that. I talked about that. Life expectancy has soared in the fossil fuel age. A lot of people are dissing on fossil fuels. Oh, climate change, blah, blah, blah. I hate to say it, guys, but the best invention for lifespan of humans has been automobiles. That is one of two that stick out completely above all else. What it did is it took horses and the bacteria from horse crap, which was killing a whole bunch of people. It took that out of the roads, it took it out of the homes, and it took it out of what we were eating. That's what cars had done, and obviously fossil fuels was a main driver of cars. Gasoline. So this was all people dying of bacterial diseases. As cars and plumbing came in, it took all the bacterial diseases and shifted the life expectancy far higher as more cars and plumbing were adopted across the board. Those are the two inventions that increased life expectancy the most. A couple of quotes here. He says, "I learned at a very early age how important it is to work hard and be honest," says Warren Buffett. Charlie Munger says the keys are discipline, hard work, and practice. And I think that basically applies to anything that you want to be good at. Michael Mauboussin on investing versus gambling. And you guys have heard me talk about I'm not a short-term market timer type of guy. It says, in the short term, it's difficult to distinguish between gambling and investing. That is true. In investing, it says, in the long term, it's easy to distinguish between gambling and investing. And your returns in investing are much higher when you take a long time frame approach in terms of your returns versus gambling, where they are all over the place. And if you're gambling, you lose over the long term. So short-term investing, for the most part, you just continually lose money. Investing, if you're doing it for the longer term, you continually gain money, and your probability of success the longer you hold goes up in terms of positive returns. Hindsight investment thoughts, and I think this is incredibly important. We were talking about this in one of the question and answer sessions. I want to touch on it. It says they can be a blessing or a curse depending on how you look at things. Oftentimes I see people lamenting on what they should have done, should have bought this or sold that, etc. But the real opportunity for learning is lost. The question always has to be why you didn't do what you think you should have done. No investor can have repeatable success without developing an investment process or strategy that suits their style. When looking at missed opportunities, consider, was the problem that you didn't have enough time to do the research to build confidence and make sure the investment or trade checked the boxes of your investment criteria or plan? Time is precious, and your lifestyle and life choices dictate how much time you're willing to allocate to your investment decision making. If you can't allocate the time or lack the desire to, then best get a professional money manager. Success in whatever you want to achieve comes from developing a solid plan and then putting in the work. Half-assing it, effort achieves a half-ass result or worse. Our most serious injuries in life often are a result from overconfidence in our skills. Underdeveloped skills too often result in catastrophic injuries, be it mind, body, or financial. Lucky streaks end, skills grow, and success follows. I want to talk about this and some things that occurred to me in trying to buy the bottoms of a lot of these bull markets. What I did is I had to drive to the root cause of the bull market. And then you look for those leading indicators of the root causes that changes the paradigm of how the herd looks at the markets. A lot of it is generally driven by inflation and interest rates reacting to that inflation. The inflation, for the most part, is determined by two things, fiscal spending or monetary. Those are the two drivers. Monetary is generally is driven by demographics. You can look at Japan's demographic and real estate market. You can look at the demographics in the United States and how it bulges and comes in with baby boomers and other demographics in the United States. So what I did to give me the confidence to buy really early is I had to look at all those things of the leading indicators of what I think are the root causes of the herd to behave differently. And the herd behaving differently will create these chart patterns. A lot of people look at the chart patterns, but the chart patterns are delayed behind the leading indicators of what I just described there. That is what's giving me the confidence to load up and stay the course. It's the demographics interacting with the real estate market and the subsequent patterns that are being created by the herd being subjected to inflation and higher interest rates. Home foreclosures are on the rise again nationwide per Fox. 32,621 properties in May had foreclosure filings, which includes default notices, scheduled auctions, and bank repossessions. That is only 3% increase from the prior year. In the prior year, we had very low foreclosures. So I think we're still early in the home building real estate cycle still. I think we're years away still from that all peaking out and getting the forced sales from foreclosures. Ryan here's got a post. It says it's actually stunning. Alberta went from half of its power grid powered by coal to zero within less than a decade. And there's that. And I know I have an idea of what probably replaced it. Natural gas. Natural gas. Fed's Bowman says, I don't see any rate cuts for 2024, shifted cuts to 2025. Is that going to increase or hold that yield curve up? And again, this is all interconnected. So if we don't see rate cuts 2024 and it shifted cuts to 2025, does that mean that we shift the recession? Or does the recession come and they're going to hold interest rates high? I don't know. I don't know about that, guys. We might be in a recession already, and I'll talk about that and why that might be. It says there are worse situations than drowning in cash and sitting. I remember when I wasn't awash in cash, and I don't want to go back to that situation. Here's Grady's opinion. He said 4.5 years ago, we were in for a glorious commodities bull market, big inflation, and probably an energy crisis. As said back then, expecting oil $250 to $300 per barrel before this bull is over, and that might be late 2020s, guys. Also said you need to make use of this bull or it will burn you hard. I do hope you took notice back then. Here's another quote. Charlie says, what you have to learn is to fold early when the odds are against you. Or if you have a big edge, back it heavily because you don't get that big edge often. So the larger problem is that renewables are having zero effect on slowing the increase in fossil fuel consumption. They're just layered on top of old energy sources rather than replacing them. In terms of solar and wind, they're not really offsetting any of the big major fossil fuel sources. And I don't know if they can. U.S. Gulf Coast LNG build-out expectations. You can see July of 24 is the beginning of this big addition of LNG. So the LNG increments are starting from July 24 and onward. Let the fun begin in natural gas. Here's Cuppy. He says, taken a step further based on nominal GDP, we've been in a recession for the past 2 years. What does he mean by that? Let's dive into it. The Chapwood Index seems a whole lot more in line with my actual inflation experience, and he's talking about the Chapwood Index. I've talked about that with a lot of people on the website about what the potential real rate of inflation is. What they do is they track the top 150 items Americans buy in the 50 largest cities. It has rose between 8% and 13.5% last year. In 2022, the range was 11 to 19%. That's the real rate of inflation. So what they're doing, the government, is they are understating inflation They log money printing on the top, which is it goes into GDP, and then they understate inflation, which increases the growth rate. If the real rate of inflation is somewhere between these numbers here, we are actually in a recession. Nominally, it's being hidden. They're hiding it nominally. So they're using the increase of all of these prices in the system, and then they're saying that that increase in the price, nominal price, and then you're saying, well, if inflation's only 3 or 4%, it means that we have all this growth. The problem is it isn't growth. We have stagflation. We are in a recession because GDP is a fictitious doctored number because of the understatement of real inflation. If you used real inflation, these numbers down here, you're actually in a recession. The world's largest copper producer is struggling to maintain production levels. Codelco copper production recently fell to a 25-year low. Many mines are old, sustaining capital is high, and grades are declining, a major problem for many copper producers. So Codelco, copper conundrum here. You can see that we basically have peaked since 2005. We haven't really increased production given all of these projects that have been producing. And it looks like to me that we are falling in production where we've hit a peak for Codelco. I think this is going to be the case for a lot of commodities over the next 10, 20 years. Copper is going to peak, oil is going to peak, nat gas will peak, coal will peak. And I don't know how we're going to make that up necessarily. The loss of all that production. Here's mindless propaganda. Solar is less than 1% of world consumption and has made no difference in carbon emissions. $10 trillion in renewable investment and nothing to show except stupid charts to promote more funding for your misleading research. Oil, coal, nat gas, biomass, and all these little things in terms of the actual output of solar and the output of everything else. Capacity is not output as well. And a lot of people use capacity as an indicator for the solar capacity. It's like, it doesn't matter, guys. The only thing that matters is the power generated from that capacity. It's power output by solar and the power output by everything else that we have for supply. A very important chart for the next macro trend. Institutions watch this ratio, and they need to wake up from their outdated 60-40 thinking. The Dow to gold ratio now has a lower low after the 2 mega back tests. This confirms a chart breakdown is coming. It means that gold is now set to outperform the stock market. That's what we've got there for the Dow Jones to gold ratio, and gold outperforming the Dow Jones. Big deal, because that's when commodity bull markets rip too. What asset makes up wealth? So if you have small amounts of assets, it's liquidity like dollars, primary residence, vehicles, retirement, and life insurance is the majority of assets for someone who's got a net worth of $10,000. As you move up, say like 10 million net worth, your liquidity is a lot less. Your primary residence doesn't make that much up of your wealth. And then you've got very little in terms of vehicle net worth, retirement, or life insurance. What makes up other portions are mutual funds in terms of those investments. Stocks make a bigger portion. Fixed income investments, managed. Real estate makes up a smaller, a bigger portion than the smaller net worths. And then business interests are really the one that changes with net worth. So I think the reason is the people who have made all of that money, a lot of their money is tied up in business interests. And that's what you see here for very wealthy individuals. It's more so tied up in business interests than it is in anything else. Got to create a business. And that is what we've got for today, guys. So give me a thumb up for the content, guys. Subscribe to the website, subscribe to the channel here. I'll keep going through these updates here, giving you guys the most recent updates. And that's really all I've got for today, guys. So hopefully you're doing all right. We'll catch you later. This is Finding Value.